the big winners and losers will be in the manufacturing space because of the reordering of the global supply
It's
chain.
in both winners and losers.
Yes, both winners and losers. I have had far greater pain, usually in the form of opportunity cost, in the third kind of error, and that I call as type 1.5 error. There will always be somewhere creation and somewhere destruction. In many ways, that is similar to what we have in the Hindu mythology, which is Brahma, Vishnu, Mahesh.
Correct.
So if you build a 2x2 matrix of these four characteristics, then you will find that the incumbents already have scale and therefore they have scalability. The challengers will not be challengers if they don't have adaptability. Sometimes it is better to be with adaptable incumbents. Sometimes it is better to be with the scalable challengers.
At the time, Rakesh bought many of these stocks like Titan or Tata Motors. I mean, these are things that instantly come to my mind. Those stocks did not obviously have great cash flows. They did not have, in fact, even Titan was a levered company at that point in time.
The term that I use for that is differentiated insight. Over the last 30 years, the largest consumption driver has been the job creation by the IT sector. We are not seeing that. One of the things Rakesh ji would tell me is we value people for who they are and not for what they have.
Hello and welcome to The Wealth Formula. This is a show where I bring to you a mix of interviews with market stalwarts, some focused on the pulse of the market for you to understand how some of the most successful investors are thinking about markets now, and certain other conversations which will focus on the how of wealth creation. In this episode, we will try and delve on a bit of both. So my guest today is the man who India's big bull Rakesh Jhunjhunwala chose as a partner and the CEO of his firm Rare Enterprises. Now he has moved on, of course, from Rare Enterprises, and he spearheads the firm he founded called the Trust Group. But of course, he brings with him a very rich experience of over 3 decades and the privilege of working with some of the legends of Dalal Street, Nimish Bhai and Vallabh Bhai of Inam, Asit Koticha of ASK, his own father, who is a very well-respected broker, and Rakesh Jhunjhunwala, of course. Please welcome Utpal Sheth on The Wealth Formula. So thank you so much, Utpal, for coming down to the studio and doing this with us. My first question to you is, what we miss today in the markets, and all our viewers really miss, is the fact that every time the market used to go through a fall or you had this level of volatility, what everybody would look for was those words of solace from Rakesh Jhunjhunwala. His bullish voice was always some kind of a reassurance. Now, looking at the market climate today, what do you have to say? How do you see the next 1 year panning out? How do you see things going forward?
Mahalakshmi, first of all, thank you for having me here. And I don't think anybody can replace Rakesh ji's conviction and his bullishness on India. He always used to say that the mother of all bull market is ahead of us.
Yeah.
We live in interesting times today, and we are probably witnessing a once-in-a-lifetime event in terms of a reordering of the global mechanism, so to say. There are multiple global frameworks which are being recalibrated, whether it is WTO, whether it is United Nations, whether it is NATO, and so on. I think it is helpful to step back and think, what are the assumptions that we have lived with all these years, and which of those assumptions are changing and how they are changing. I do not aspire to claim to be an expert on the geopolitical situation, but I think how it is impacting Indian companies and how Indian companies are responding to it is something that I'm observing. For the
But quickly, your prognosis for this year. I mean, are we done with all the selling? Is this going to be a volatile market? Is the worst behind us? What's your general sense?
Okay, I think that we were in need of a valuation correction. There was some insanity there, and that has been significantly corrected. We have recalibrated growth expectations for sure. Question is, have we recalibrated margin expectations? I'm not sure. And with regard to growth expectations, I would say I am looking for companies which can grow in a challenging growth environment. So growth is usually derived from from macroeconomic growth, the nominal GDP growth, and B, from market share displacement. I would prefer to look at companies which have the right to win and benefit out of the market share displacement. If the nominal growth is very good, they will surely participate in that as well.
Right. So you said that we have recalibrated growth expectations, but not margin expectations. What did you mean? Can you elaborate?
In all the trade upheavals that are happening globally, the reality is in many sectors, China is 30 to 35% of the global manufacturing output. And if that needs to be consumed somewhere other than the US, then it might deliver a supply shock to the rest of the world. And that supply shock can result in significant pressure on prices. Now, how that impacts Indian companies remains to be seen. How long this global trade's fluid situation persists also remains to be seen. But as an investor, it is my duty to position my portfolio accordingly, to hope for the best, but also prepare for the worst.
Right. So you're saying this, the market, by the way, from April 7th onwards, when we saw our low, it's really rebounded very sharply. And the interesting thing is India has been the top performing global market in this sort of a rebound. So in a sense, it seems like the market is interpreting that, India is going to come out winner of this whole situation. You're saying that needs to be tempered. Is that correct?
No, I'm not saying that India will not be a winner. That's not my hypothesis here. But to understand the market dynamics better, the leader in this time frame that you mentioned has been the financials,
right,
which are not being impacted by the trade upheavals,
right.
So the market, and where the valuations were very, very compelling. Reasonable. So I think the market is very right in the financials leading the charge, so to say, in this phase. In the non-financials, and specifically in the manufacturing, there will be two sets of companies. There will be one set of companies which will be the winners, and the other set might not be the winners. So those companies which will benefit from maybe a global market share displacement, they will surely be the winners.
Right.
But those companies which do not benefit from global market share displacement and are vulnerable to global pricing pressures, those will be having challenges. Fortunately, the Indian government has been very proactive and is coming in with safeguards wherever required. But let us step back and think of a framework of what we are looking for in companies in this kind of a global environment.
Right.
So I will use an acronym, if you permit, called RACES, RACES.
Before we get into the framework, just one question, that if you just look at sectorally, first of all, there are 2 or 3 narratives that are emerging here. One is that people have been saying that, if you need to cope with this global volatility and, externally influenced, changes in the market, then look at domestically focused companies. That is one narrative. The second thing is, there are a whole bunch of companies which we see, which were also called the narrative stocks, by the way, but a bunch of it was because there is a defense theme or things that have very strong tailwinds. If you were to scan the market, are there any obvious sectors that you think are going to be vulnerable and sectors that will thrive in this environment? Before we get to how to evaluate and size up companies, broadly in terms of sectors and themes, is it visible to you?
See, last few years we've had a reasonably unexciting consumption growth picture in India. And in whichever way this plays out, it'll be, consumption could well be a very strong possibility. But what are the underlying drivers for that consumption to grow? Right? Are real incomes increasing? We are not seeing that yet. And over the last 30 years, the largest consumption driver has been the job creation by the IT sector. We are not seeing that. Right? We were seeing growth at the higher end of the consumption buckets. Will that continue? Probably. So, to my mind, identifying winners and losers amongst non-manufacturing spaces will be relatively easier. Like in the recent past, the IT services space has been beaten down quite a bit, right? But the big winners and losers will be in the manufacturing space because of the reordering of the global supply chain.
Both winners and losers.
Yes, both winners and losers. And Mahalakshmi, again, to bring in another framework that I have, is this concept of creative destruction by Joseph Schumpeter.
Right.
There will always be somewhere creation and somewhere destruction. Value creation and value destruction. In many ways, that is similar to what we have in the Hindu mythology, which is Brahma, Vishnu, Mahesh.
Correct.
Right? The creator, the nurturer, and the destroyer. So I feel that the value is going to migrate significantly. It is up to the investors to figure out how the value migration takes place.
Right. Okay, we'll come to that. But before that, to the RACES framework.
Okay. So the RACES framework sits on top of the other investment framework that I have been espousing over the years. My fundamental investing framework is that of terminal value investing, which is driven by megatrends, leadership, and intangibles, which leads on to, wherever you find the intersection of these three are potentially gorilla companies, which is what as an investor one would always like to have. These gorillas are rare, they are dominant, and they have longevity. Now, on top of this framework, given the challenging global environment that we have today, I would look for specifically these 5 characteristics, which I have used in the acronym RACES. RACES. R for resilience, A for adaptability, C for competitiveness, E for execution, and S for scalability. Okay. Each one of these is important. Finding the confluence of these 5 capabilities, to my mind, will be the secret of finding companies that can benefit from
today's environment.
Yes, from this creative destruction process.
Okay, so explain each one of them. So what do you look for to evaluate resilience?
Right. So the context of resilience is essentially durability. Companies which can survive through business cycles. Right. So clearly unlevered companies, companies with high ROCs and cash flow generations, those will be the financial characteristics.
Right.
But the financial characteristics are an outcome of your underlying business model and business design. Right. To find companies which can take market share and which have pricing power, to me is the essence of the resilience that they can then demonstrate. Companies that have financial prudence and capital allocation discipline will have resilience. I think today we are in a temporary global dislocation, hopefully temporary global dislocation, right? And therefore, in these dislocations, you will find adaptability is an important characteristic. As Charles Darwin has said that only those who can adapt survive. It is all the more important in a dynamic world where the pace of innovation is accelerating. There are two kinds of companies always. One is incumbents, one is challengers. And there are two important attributes for these companies which are relevant. One is scalability and one is adaptability. So if you build a 2x2 matrix of these four characteristics, then you will find that the incumbents already have scale and therefore they have scalability. The challengers will not be challengers if they don't have adaptability. Right. So naturally they already have adaptability. As an investor, I would look for the attributes which are not naturally available, which is I would look for adaptable incumbents and I would look for scalable challengers. Right. The incumbents have the advantage of having cash flow, having customers. The challengers also do not have the disadvantage of cash flow because though they don't have cash flow, they have access to capital. Fortunately, India has a well-developed VC and PE ecosystem now. Right? India used to be a capital-starved, risk capital-starved country, and we now have very significant pools of risk capital which are accessible. So, the winners will be determined by whether they fall into one of these desirable buckets.
Right.
The scalable challenges or the adaptable incumbents. Sometimes it is better to be with adaptable incumbents. Sometimes it is better to be with the scalable challengers. You mentioned about companies which have done well in the last few years, who've been listed in the last few years. All of those are the scalable challengers. So this is what I would look for within the adaptability.
Some examples of adaptable incumbents.
I think every sector you will have these examples. In, let's say, in the financial sector, clearly Bajaj Finance has been a good adaptable incumbent. In, let's say, the consumption sector, maybe a company like Jubilant FoodWorks has been an adaptable incumbent. And again, disclaimer, I would like to bring in the disclaimer. This is not a recommendation, but this is just an example to demonstrate the characteristics. I may have exposure to these companies.
Right.
Examples of scalable challenges would be the likes of Zomato or Paytm. They have built these companies and these platforms over a very short period of time and have scaled them very well. Let's talk of the third one, which is the competitiveness.
Okay.
I think to be favorably placed in this global displacement opportunity that we are talking about, one will have to be globally competitive. Okay. And when we say competitive not just in costs, not just in execution, but also in innovation. Okay. And I think over the last few years in India, we've undergone a process where there has been a shift from the unorganized sector to the organized sector. And within the organized sector, from the weaker players to the stronger players. Hopefully, the stronger players now have adequate heft to be not just national champions, but to be global contenders. I think we are too far away from using the word global champions. So I will say we will look for companies.
You have a chance to win.
Yes. We will look for companies which are national champions, but are also global contenders.
Right.
So that is with regard to competitiveness.
Right.
Then let us come to execution. See, one of China's greatest strength has been execution. And that has not been a big strength in the past. Very few Indian corporates have delivered world-class execution. I'm not saying there are none. There are a few. So we need to see that execution at global scale from Indian companies. And I do understand that there may be, challenges within the country's ecosystem, which will have to be overcome in many ways. But we are fortunate to be having a proactive government, and even if things are not perfect today, they are surely improving.
Right.
Right. So I would be looking for these global contenders who can execute. The last one that we talked about, which was scalability. See, we've been able to scale platforms, right? I gave you two examples.
Yeah.
But they are both on the digital side.
Right.
To see companies which can scale manufacturing platforms, I think would be phenomenal if one can get there.
Right.
Right. I think there are some companies in some sectors which have become national champions in their respective spaces and have a good shot at becoming global contenders.
Do you ever see contradictions within these, 4 or 5 parameters that you've talked about? And how do you balance them?
Right. So think of it this way, that you need not get all the 5 in every company that you look at.
Right.
Right. Chances are that you will get 3 or 4 of the 5 attributes. But if in those 3 or 4 attributes you have adequate conviction, then I think it's fine. Okay. But the quantum of advantage in those 3-4 attributes has to be large. We are not looking for marginal advantage in those attributes.
So how do you explain? Can you explain with an example or some way of quantifying it?
Let's say a company has demonstrated adaptability. Well, to use one of the examples that we discussed earlier, the way Zomato made a pivot from just the food delivery business to the quick commerce business.
Right.
Right. that demonstrates phenomenal adaptability. I remember that at the time that they made that acquisition,
Yeah, there was a lot of skepticism.
there was, and they did so well
Right.
to not be bothered by that skepticism, but executed beautifully. So you got both adaptability and execution. And look at the way that they have scaled it, right? So you got scalability. So you, as I said, you will find they wouldn't have been able to do this if they did not have competitiveness.
Right. But Utpal, how do you figure this beforehand? Because today, like you rightly pointed out, in Zomato's case, at the time it happened, there was so much skepticism that, it was an expensive acquisition. There were also some governance issues around it. But in the end, they executed it. And today, people think of Blinkit as a bigger opportunity than, Zomato's food delivery business, right? So how do you know? Is it a bet on the person? Because I know that, and I think we should talk about this a lot more, that how central is the team or your faith or conviction in the promoters in all of this? Is that very central, or do you take a call on the business? Is that the more important piece?
I think all of these 5 attributes that we are talking about today, for that, the quality of the management team is very vital. Okay. And in India, unfortunately, we've always been thinking of promoters in a different way.
Right.
Right.
Not a very charitable way.
We don't look at separation of ownership and management.
Right.
Okay. I would urge you to think in those terms where there is separation. There may not actually be separation of ownership and management, but let's look at management teams, because there are many companies in which there are outstanding management teams who may not be promoters and who have delivered brilliantly. So I feel that I would give very high weightage to management quality when I'm looking for these attributes. For these attributes, the management quality makes all the difference. It's not just the business design. And if the management quality is right, then they will take care of the business design. If there is a flaw in the business design, then they will amend that.
Okay, so is this in a way different from what Warren Buffett says when the reputation of the business is at odds with the reputation of the management? It is the reputation of the business that supersedes. Is it different from that?
No, I wouldn't say it is different from that, because he also said that, he said that at a time when the pace of change and the volatility globally was very different. In today's volatile, uncertain world, right? Where you have dynamic variables changing at such a rapid pace and scale, I think management quality is the number one variable, because it is the management quality which will navigate the scenarios.
In any case, I think your first condition that the mega trends, all of this has to fall within your umbrella of mega trends where you have tailwinds. So you're already taking the business aspect, I guess.
Yes, the business aspect in terms of the business environment, right? But the business design and the business architecture is still important.
Sure,
so
understood.
When I say that the management quality is important, I'm not belittling the importance of the quality of business design and business architecture.
Right.
But I'm saying that if there is a flaw in business design and business architecture, then the management teams will adapt and pivot as necessary.
Right.
But that is only if the management teams are high quality management team.
Right. So have you ever invested in a company where you haven't met the promoter? What does that scenario really look like?
See, to make real long-term investments,
you need to have
you need to meet the management. And I'll again prefer using the word management team rather than the word promoter.
Right.
Because in many cases, management teams are not promoters. And even where promoters are the management team, I look at them as the management team more than the promoters. While we've talked about all of this, let me also use one or two other important parameters which determine, even if you get all of these attributes right, if your capital allocation and capital structure is flawed, you will end up destroying value. So the construct that I have in my mind is that the right management team will also take care of capital allocation and capital structure.
So are there any guardrails that you think about this? You said that when you say management, it is actually the executing management. But you also consider the promoter, if he is running the business, as very much part of the management. Fair enough. But in the end, the capital allocation decision rests with the promoter, right? Like in a promoter owner managed entity. So where do you get that confidence? And there have been so many cases where, everything's going right, and then the promoter decides that they'll put money into a new business, and then it spectacularly fails. Is there anything that you think about, some questions that you ask? Is that a candid conversation with the promoter so that gives you a reassurance that you are going to stay in this business? Is all of that conversation, how does it go?
See, Mahalakshmi, everybody has a track record. Everybody has a history, right?
So that history is important.
That history is important. You are able to recognize prudence as a mindset of the management team and or the promoter, as the case may be. You are also able to recognize how they think about risk based on the actual decisions taken over a very long period of time, right? So even if you want to experiment, you will experiment it in such a way that risk is mitigated. That if you fail, fail fast.
Right.
And fail in such a manner that you can bear the cost of failure. Unfortunately, so it's not just, the perception that experimentation is wrong is not correct. Businesses and management teams must experiment. But they should do it in a way where risk is calibrated, risk is mitigated, and if required, fail fast.
Sure. And tell me, how do you navigate when you cut your positions? Is it something goes wrong with the business, or you lose faith in the management, or what are the triggers when you sort of exit?
The typical exit framework that has worked for me has been, one, if my investment hypothesis breaks, right? And my investment hypothesis is not inflexible, it is not a constant. I do revisit my investment hypothesis every few months and years, because if the investment hypothesis is broken, then you are only hoping for a greater fool to bail you out. And that does not work for me. So that is the primary reason. The secondary reason is if I have a very, very compelling relative opportunity. But compelling relative opportunities are not everyday occurrences, right? For you to build the same degree of conviction in one more company, which is so compelling that there is a strong case to switch from one to another, is rare. The last one is when you feel that there is, in general, insane valuations. But this is the one aspect of selling which I have not been great at. Okay, because in the style of investing that I practice, which is terminal value investing, I'm looking at the 10-year out terminal value for a company. And if there is a valuation exuberance in the interim period, which may be unjustified, I find that if I exit, then my ability to re-enter when it corrects, right, is not, I cannot take that for granted.
Right.
And the opportunity cost of missing out on a very long compounding play, is too high. So one more framework that I have is what I call as the mistakes framework, right? So we usually talk about two kinds of mistakes: errors of omission and errors of commission.
Right.
But I found that I have had far greater pain, usually in the form of opportunity cost, in the third kind of error, and that I call as type 1.5 error.
What's that?
And that is the error of hesitation or reluctance.
Right.
Okay. Where you built your conviction, but you tried to be too cute on valuations or too smart on timing and missed out on a very long compounding opportunity.
Right. So largely you're saying that, even if the valuation goes above board, you stay put because the risk of reinvesting appears large to you. But what is insane? You said if it is insane valuation, then you get out. What is insane?
So, see, sometimes valuations of one company going up more than proportionately is okay. But when you are in an environment where all valuations are unhinged in some way, that is a time to be very cautious, right? And again, that's probably a time not necessarily to exit everything, but at least to trim. So automatically that kind of trimming will happen. So insanity that I'm talking about in valuations, I'm not talking about insanity of specific company valuations. I'm saying that when we are in a very broad base, generalized environment of insane valuations, that is the time to be trimming.
You would describe the peaks in September as a point like that, or it was still lower than that, or any time in the past 1 year? Did you feel like that?
I don't think September was a time of generalized insane valuations. I think the financials and the large caps were very reasonably priced even then.
Right. So and that's a large cohort of the market also.
So I think there was a segment of the market which had moved a little ahead of itself and that got corrected. The important point as an investor, rather than time the market, was which were the companies that you partnered with, right, and invested in. And since the style of investing that I advocate is a 10-year view,
right,
even if you make a mistake on the entry price, what you've lost at most is some time rather than permanent loss of capital.
Right. Okay. Another question I've always wanted to ask you, and at some point in time, Rakesh also, is that, at the time Rakesh bought many of these stocks like Titan or, Tata Motors. I mean, these are things that instantly come to my mind. Those stocks did not obviously have great cash flows. They did not have, in fact, even Titan was a levered company at that point in time. Tata Motors was nearly going bankrupt when he bought. So how do you estimate risks? How do you think about risk? Because some things are clear, but at that point in time, it's not, I'm sure it's not 50-50, but there is an element of risk. How do you think about that, and how do you size up based on that?
So, Mahalakshmi, there are two kinds of approaches. One is you try to find compounding stories which compound for a very long time. And the second is you try to find companies where there is a catalyst and which gives you a big upside. Rakeshji was a unique investor who could look at the terminal value and yet not lose sight of his entry price. Okay. That combination was very powerful. In some of the examples that you mentioned, right, I think he was able to very accurately not just assess what was the long-term flywheel required or necessary for compounding, and that there are attributes that we discussed which are components of that flywheel, but also what is the catalyst for the change that is being brought about, right? And I think that combination worked beautifully for him. So, for example, in one of his very famous investments, there were two businesses, watches and jewelry.
Right.
One was loss-making, one was profitable. But when he understood that the unit economics of the loss-making business had actually turned, then you knew that in due course this will work out. And you knew that the scalability there was far greater than the scalability in the watches business.
Would you say he had greater risk appetite?
The term that I use for that is differentiated insight. Okay. So once you, and Rakeshji used to be a genius at being able to identify and capture that differentiated insight in his mind. But once you have a differentiated insight which allows you to understand that over the next 5-10 years, things will play out favorably, that helps you build your conviction. But I will add one dimension to this, and which Rakeshji used to do beautifully, is that his calibration of his positions was synchronized to his conviction in the companies. So the first time that he gets a differentiated insight, he will he will take some exposure. And as his conviction
levels go up,
keeps going up and keeps getting validated, right? He will keep adding to those positions. In the past, he's added at not just a few percentage points higher, but he's added many multiples higher as well.
Right. So that's the next question. So again, what are some of the principles, of buying after you have done the first purchase? We say higher price, but sometimes what we know is price is not what you focus on. You focus on value. So in terms of valuations, do you keep the same kind of valuation, or do you account for the fact that because there is greater level of conviction, because the company is more proven or a better track record, you have to pay a higher valuation also? So what are some of the principles around buying higher?
So let me quote Rakeshji here. He used to say that investing is an act of wisdom and not intellect. Okay. So it's not a mathematical formula that you keep the valuation constant or any such thing. I think what he was doing, the term I use for that is probabilistic portfolio management. As the probability in his mind kept improving, he would keep increasing the weight. However, this was a necessary condition and not a sufficient condition. What the sufficient condition was that even if price had gone higher, if the terminal value in his mind had gone even
higher.
more higher, then he wouldn't mind paying the higher price. The terminal value that we are discussing was never a DCF methodology. It was a nebulous figure, and getting the direction right was far more important than getting the speed right.
Right. So since it is not DCF, can you give some sense of how do you value companies? Some people think about payoffs, like 5 years में सारा profit जो price pay किया 4 साल में वापस आ जाना चाहिए. Is there any mental model to think about valuation?
So in one of my earlier avatars, I used to interact with Rakesh ji, and Rakesh ji had bought, I'm talking of mid-90s, he had bought United Spirits and United Breweries. And when I was discussing that with him, I was myself a big advocate of both United Spirits and United Breweries. But his perspective was unique. What he said was, do you think that a 40% market share of India's alcoholic beverages market should be available for 400-500 crores market cap? Such a simplistic and yet such a powerful way of thinking about it. Right? So you don't need very complex analysis for that. So he may not have had a specific number in mind, but he knew that the direction was right. That the terminal value of that 40% market share of Indian alcoholic beverages is worth many, many, many times more. So therefore, discussing 400, 500 is not relevant.
So, of course, in hindsight, you can think about promoter risk. Was that not something that he was concerned about?
Sure. He was concerned about that. But he understood that in many ways, these companies had already demonstrated leadership in their respective businesses. They were 40% market share companies in both the markets, right? Whether spirits or breweries, and sustained those market share leaderships over a very long period of time. So in many ways, he gave the benefit of doubt to the professionalization of those businesses.
Right. So since we are talking about a different era where prices were so low, between then and now, how has the investment landscape in your perception really changed? Because when we look back, it looks like that was the greatest time to invest. And it is as if the best of the stock market is already, is behind, not ahead. Is that something you subscribe to? And in many other ways, if you think, we say that, we have become far more resilient. Our companies have become bigger. Our business environment is better. And therefore, the next billion or the next trillion will come much more easily. And therefore, this is perhaps the best time to invest. How do you see it?
Yeah. So see, I remember in 2002-03, the index PE multiples were in the vicinity of 10 times on a trailing basis, not forward.
Correct.
Okay. That was a different era for sure. Having said that, India was not as globalized at that time. Our interest rates were very different.
Right.
The strength of our banking and financial system was not all that great at that time. And so on. So I think at all points of time, there are multiple variables which are changing. So holding on to the fact that just because index PE was so low at that time, the best is behind us, I would not subscribe to that. I feel that the genre of entrepreneurs that are available today, that we keep seeing, I have great regards and respect for them in their ability to create value. And therefore, I feel that I feel as excited about investing today as I did then.
Sure.
I may not get the same returns going forward, but that's okay.
Right. True. Okay, Utpal, you've had the privilege of working with some of the best, the legends of Dalal Street. You've worked with Asit Koticha, you've worked with Vallabh Bhai and Nimish Bhai, you've worked with Rakesh Jhunjhunwala, of course. Tell us, what are some of the distinguishing styles of these three people? In some sense, they all look for value. You can say that. But at the level that you would have looked at, they would have had very different ways, while the overarching philosophy may be somewhat similar, very distinctive styles. Tell us about that.
So first of all, let me say, yes, I have been privileged to work with some of the best mentors and teachers that I could have ever wished for. But I would like to add one name.
Your own father.
My father.
Absolutely. Because I think that is the starting point.
Yes.
I'm sorry, I should have said that first.
So, in many ways, I'm very grateful to each one of them. And I don't think it will be fair on my part to comment on them or their styles of investing. What I can do is I can share some learnings that I've had right from all of them. So to begin with, my father used to talk about a concept called growth phase.
Mm-hmm.
Okay, he was a big believer in that every company goes through a growth phase. In today's lexicon, effectively, we use the word inflection point. Right. So when you have growth phase or inflection point combined with a favorable megatrend and leadership attributes and intangibles, that becomes magical. Also, I think the discipline of entry valuation was something that I learned from all of these investors. And that discipline was most valuable when they were investing in high quality companies. Okay, having valuation discipline when you are investing in companies which don't have that high quality is very different. So to be able to see when you get them at a price which justifies your valuation discipline, there must be some temporary cloud on those companies.
Right.
Otherwise, you will not get those high quality companies at that valuation. Low prices, right? So the ability to look through that temporary cloud,
right,
I think, and perceiving that the high quality is sustainable beyond this temporary cloud.
Right.
I think that was a fantastic skill set.
Right.
So it's valuation discipline combined with the ability to look through a temporary cloud and perceive the high quality terminal value.
Right. Understood. That's the learning from your dad.
No. I'm saying from all of them. All of these.
Okay.
The growth phase was from my dad. Also, the power of conviction. I cannot emphasize enough. There may be stocks which somebody else may have identified before Rakeshji, but Rakesh's ability to back his conviction, to thump the table and build a very meaningful position, not just because he had a larger portfolio, but also that he made it much larger as a percentage of his portfolio.
Right.
Where he made his winners count. Right. So that was again, I think the power of conviction is a very important learning, and you could see that conviction in each one of them. Whenever they talk about the companies that they believed in, their passion and their excitement would be dripping.
Right. But again, on sizing up a position, anything to think about? do you ever think about what is the proportion of your portfolio? Is it too much risk? Is it too less risk? Or are you just driven by this is a 25% compounder and I want to get as much as I can? Or at this price, this is available, so let me take it. What are the considerations?
Terminal value is so vastly many multiples of the current price. One does not worry about the nuances of over concentration or not. Because when that happens, in your mind, it is better than all other relative opportunities that you can think of.
Right.
I'm not saying this is the best of all relative opportunities, because you are not privy to all the best opportunities in the market necessarily.
Correct.
But wherever you have conviction, if this is the one that makes most sense, then you keep adding. But the specific incident that I wanted to talk to you about was once I went to Rakesh and I said that, look, our percentage exposure to our largest holding, which is his most storied holding, has now crossed this number. And therefore, should we think of trimming? And he said, is your conviction any lesser? If not,
why should
why? Do you have an alternative in mind which is better than this? Then let's talk. So clearly, he had a laser sharp focus on what I call as probabilistic portfolio management, where his conviction used to get reflected in his portfolio weights. One last that I will add in my learnings is that even your best investments will go through periods when the numbers don't keep ramping up the way you expect them to, right? And that is when I remember Rakesh's lines, your patience may be tested, but your conviction will be rewarded.
Right.
Okay. So I cannot tell you how vital it is for you to maintain your conviction at that time. But you don't maintain that conviction blindly. You revisit your hypothesis, rebuild your conviction, and then maintain your conviction. Okay. Rakesh's ability to sit through such periods of temporary underperformance on the numbers was immense. And if he did not have that, he would not be the legendary investor that he was.
Right.
And this was something that is a common trait amongst most of these great investors that you just discussed.
True. So one question, you clearly told me that we shouldn't get into stock specifics, but I was just looking at your portfolio, Garuda Construction, AYM Syntex, Raghav Productivity Enhancers, Autoline, Protean. These are some of your holdings that you can have, people can access on Moneycontrol and Trendline. Without getting into any of the specifics, tell me, what are some of these stories? Where do you see? Because in today's context, what is the thinking around some of these companies?
Right.
And this is not a recommendation to buy or sell. Of course, he holds all these stocks. Just to understand the theory or your thinking behind some of these stocks.
Right. So, you will always find disclosures of my small portfolio only in these small companies.
Right.
The rest of the portfolio is in larger ones where I'm a small shareholder.
Correct.
Therefore, otherwise you will come to the conclusion that I'm predominantly a small cap investor, which is not right.
Correct.
Having said that, I don't wish to comment on any one of these companies, but I do wish to make a point here, and which is, as I shared with you earlier, that I keep seeing a new genre of entrepreneurs who are becoming national champions and hopefully global contenders, right? They need not always be the largest of companies. Some of the smaller companies are also demonstrating those characteristics. Okay. So there is great satisfaction in being a small investor with these companies.
Before I let you go, Utpal, some of your favorite stories with Rakesh.
One of the things Rakesh would tell me is we value people for who they are and not for what they have. Right? Very profound statement. Very simple, but yet profound. Right? Another characteristic that each of those investors had was their ability to recognize the quality of people, whether it is in the business world or it is outside the business world. But their ability to read people was fantastic.
Right.
The third one was to think, to be a realist and to be practical. So, while that sounds very simplistic, it's not that simple. Rakesh used to say that good business is a gain to you without a loss to me.
Right.
Or a gain to me without a loss to you. So he would always tell me to think win-win in whatever we did. It was not win-lose. So having that grace, having that larger heart was important. And again, that was a common characteristic in all the others that we discussed.
Sure. Thank you for this lovely conversation, Utpal. Really enjoyed this. Thank you for your time.
Thank you, Mahalakshmi.